Have you ever, looked at a chart where the price is just absolutely plummeting, but the smartest traders are quietly getting ready to buy?
Yeah, they aren't guessing, they're watching the momentum shift before the price even has a chance to react.
Exactly. Today's deep dive explores exactly how they do that, focusing on the Relative Strength Index, or RSI. Welcome to everything you need to know about finance.
Glad to be here.
Oh, and just a quick note, this is not a financial advice, just a deep dive into the mechanics of this concept.
Right, exactly. We're just looking under the hood.
And real quick, if you find this kind of content interesting, please like and subscribe. So let's set the stage. The RSI has been a hugely popular momentum oscillator over the past few years, right?
Oh, definitely. And it remains heavily relied upon in recent markets, mostly to measure the speed and, the overall change of price movements.
So let's get into the basics of how it actually works. It's basically a scale from 0 to 100,
Okay.
based on a 14-day period.
Yeah, that 14-day look back is standard. It just compares the magnitude of average gains to average losses over those 2 weeks.
I always like to compare RSI to a car engine's temperature gauge.
Yeah.
If it goes above 70, it's quote-unquote overbought, like the engine is running dangerously hot and is due for a correction.
That's a great way to picture it. And then obviously below 30 is oversold.
Right, like it's stalled out but primed for a bounce.
Yep.
And then 50 is just your neutral cruising speed.
Exactly. And that mathematical ratio is crucial. When a stock hits an RSI of 30, it just means the average losses over the last 2 weeks have severely outpaced the average gains.
Meaning the selling pressure has reached this, mathematical extreme.
Exactly. And traders use that for basic reversals buying when the RSI dips below 30 and then crosses back above it. But there's a stronger signal, too.
Divergence, right?
Yes, divergence is huge. Say the stock price hits a lower low, but the RSI hits a higher low.
Wait, really? So the price is dropping, but the downward momentum is actually dying out?
Precisely. You're catching the shift in the underlying supply and demand before it fully reflects in the price action.
Okay, hold on. If we flip that, say we're in a roaring bull market and an asset crosses that 70 threshold, my immediate instinct is to lock in profits. I mean, the engine is overheating. Why wouldn't I take my money and run?
Well, see, that instinct is exactly how you fall into the strong trends trap.
The strong trends crap.
Yeah, in a prolonged bull run, buying pressure is relentless. The average gains consistently outpace the losses, which keeps the formula pinned at overbought for weeks.
Oh, wow. So if I sell blindly at 70, I just miss out on the ride.
You miss massive sustained upside. Jockey markets can trigger a lot of false signals if you just sell blindly at a number.
So treating every ticker exactly the same is basically a recipe for disaster. You have to contextualize the asset's normal volatility.
Fundamentally, yes. Take an individual mega cap like Apple versus a broad index like the S&P 500.
Okay, so Apple is much more volatile.
Right. Say a temporary supply chain issue hits Apple. The stock plunges, dragging the RSI down to 32. Because it's an isolated, volatile asset, that panic selling often dries up quickly.
Which makes it a prime target for a short-term oversold bounce.
Exactly. But if the S&P 500, which is highly diversified, slowly grinds its way up to a RSI of 72, that's a completely different story.
Right, because it's 500 massive companies all moving together.
Exactly. It takes immense macroeconomic strength to push an entire index into overbought territory. If the S&P hits 72, it usually confirms a healthy, powerful trend.
So you don't short the index just because it hit 72.
There's no way. You'd be stepping in front of a freight train.
So as you watch the future of a volatile stock like Apple versus a broad index, you really have to remember that RSI means different things for each.
Yeah, short-term bounces for single stocks versus long-term trend strength for a broad index.
Which brings up a really provocative thought for you to mull over. If the RSI only calculates the momentum of the past 14 days, what hidden fundamental forces is this indicator completely blind to?
That is the million-dollar question. I mean, it doesn't see shifting debt structures, executive turnover, incoming regulations, none of it.
Right. It is completely blind to all of that.
Yeah.
So keep that in mind before you treat any momentum oscillator like absolute gospel. Try out our latest episodes, and we will catch you on the next deep dive.